Did Jerome Powell, the head of the US Central Bank, just unleash a massive bomb on the markets? Or was whatever he said in line or as expected with what he's been saying all this time? Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. If you're interested in macro content, macroeconomics, you're interested in stocks, bonds, commodities, and how it relates, all these macro knowledge and information and how it relates to the equity markets and the financial markets, feel free to subscribe, hit the like button as well. If you're interested in more knowledge on courses on how macroeconomics and how the world works and how that ties in with the financial markets, then feel free to check out our website. The link is below in the description. It's www.infovesting.com, and we've got multiple courses on macroeconomics, trading, and investing in the markets from a macroeconomic point of view. Now, let's get into the press conference, what happened here, what happened during Powell's testimony. He came out, testified in front of Congress, talked about a lot of things, was grilled a lot by Congress, asked a lot of questions. But the most important thing was the prepared remarks that came out before Powell went live. And we're going to go over the prepared remarks here. I have it in front of me, and I'll link it in the description for you to read up on it as well. And it was the prepared remarks that caused the markets, the stock markets, to completely plunge, the bond markets to plunge as well, especially more on the shorter end, caused gold to plunge, the dollar to rally, all off of the comments that were made from the prepared remarks. So let's go through it. Let's talk about it. Let's see what is this? Is this prepared remarks truly something to worry about? Is it new information? What can we take out of this? And what does it mean when it comes to the financial markets and the economy? So let's go through the first paragraph here. I'll skip through a couple of paragraphs, but I'll go through the first one here. So it starts off with, my colleagues and I are acutely aware that high inflation is causing significant hardship, and we are strongly committed to returning inflation to our 2% goal. So it starts off saying that, hey, don't think for a second we're going to go and just go for a 3% inflation target or 4%. We're really committed to this 2% target, and we're gonna go for it, right? We're not going to be the first Federal Reserve, the first chairman to back off from the 2% target just because inflation is crazy high and we can't do anything about it, right? Because if they do that, then definitely it will look really bad on Jerome Powell. So he starts off saying 2% is where we're going, and that's where we're going, as simple as that. Over the past year, we have taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far yet to be felt. So we tighten a lot. We acknowledge we tighten like crazy, but still we have yet to see the full effects in the economy. Inflation is still sky high. There's certain components of the inflation report that are sky high, and we still have a lot more work to do. Our policy actions are guided by our dual mandate. They've got a dual mandate, which is to promote maximum employment and stable prices. So they want to bring inflation down while having maximum employment. Now they do have maximum employment. Employment is at record lows, around, I think it's 3.4, 3.6%. We'll get into that later in this remarks. So without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve sustained period of labor market conditions and benefit all. I will review the current economic situation before turning to monetary policy. So he then gets into the current economic situation and outlook. That's the title. So let's get into that. So basically, in the first paragraph there, it says the data from January, the employment, the consumer spending, inflation, etc., have partly reversed the softening trends that we have seen in the data just a month ago. Some of this reversal likely reflects the unseasonable warm weather in January in much of the country. Still, the breadth of the reversal along with the revisions and previous quarter suggests that inflationary pressures are higher than expected at the time of our previous FOMC meeting. So basically saying that, hey, the expectations that we had for inflation previously in the last meeting, we thought, it would be better, but they're higher than what we've expected, which is hawkish, which is not good, because it means that they're getting their expectations of what inflation would look like. They're getting it wrong, and they got to do something about it. Now, from a broader perspective, inflation has moderated somewhat. So we've seen that last year, inflation has come down, but still remains above the FOMC longer run objective 2%. They need to hit the 2% target. So it talks about a couple of inflation metrics here. I'm going to skip that paragraph. Over the last 12 months, talks about core PCE inflation, the bottlenecks, the supply chain, etc., etc. Now, here's an important paragraph. It's about 4 paragraphs from where I started. He says, so he talks about all this inflation, talks about the PCE, housing, services inflation continues to be high. Then he says, that said, there's a little sign of disinflation thus far in category of core services excluding housing, which accounts for more than half of core consumer expenditure. So this line is key because previously, right, Jerome Powell came out and said, we are in a disinflationary process. We are in a disinflationary process. And the markets were rallying off of that. Stock markets were going up and saying, hey, he's saying that inflation's finally coming down. Does that mean rates are going to slow down and stop? That's a very good sign. He said this just 1-2 months back. Started off the previous FOMC press conference, and he came out with a follow-up saying that we are in a disinflationary process. Sure, you do see that inflation has peaked last year and somewhat come down. However, he does now acknowledge going from really dovish to now complete, more on the hawkish side, you could argue, that there is little signs of disinflation thus far, completely changing, completely going on the opposite side, saying we're in a disinflationary process, but hey, now, listen, we see a little sign of disinflationary. So what is it? Where are we? Are we in that disinflationary process? We still probably are, but he's backtracking, saying that, hey, we are in that, but there's a little sign of it, right? So that comes off quite hawkish. Also, when you look at the category of core services excluding housing, right, that component where he said that he's going to monitor, that component still remains elevated, right? It still remains elevated and it's not coming down. He said he's going to focus on that because that's what matters. He says we're excluding housing because housing is, the shelter component is what bringing up inflation higher. So, okay, fine. Exclude it out of your calculation. And what do you get? The number is still pretty high. It's still elevated. And this number accounts for more than half of core consumer expenditures of consumers going out and spending on certain items. So if that is still a problem, and after him making adjustments, the number inflation is still not coming down, that's not a good sign. So to restore price stability, we will need to see lower inflation in this sector. We need to see his favorite number, the core, the super core number, as people call it. We need to see that number come lower. And there will very likely be some softening in the labor market conditions, which basically say, hey, get ready for more job losses. You may lose your job. Although nominal wages gains have slowed somewhat, wages have slowed, kind of, a little bit, somewhat. They remain above what is consistent with 2% and current trends in productivity. Strong wage growth is good for workers, but only if it is not eroded by inflation, right? So you do see higher wages. He does say that there needs to be some softening in the labor markets. And guess what? If you have less issues of people finding workers, then yes, that wage component will get softer. If you lay off more people and companies need less workers, then yes, that wage component will also soften as well. So it comes down to that employment component. So then he talks about growth in the next two paragraphs, and so we'll skip that, but I'll actually mention one part in the growth component. So the very last paragraph, he says, despite the slowdown in growth, the labor market remains extremely tight. Right, the labor market is still strong. The unemployment rate was 3.4% in January. So like I was saying in the beginning, so it's 3.4, not 3.6, 3.4% in January. That's the lowest level since 1969. Now I want to bring this up and I want to mention this to you guys that, hey, 3.4%. If you got an unemployment rate at 3.4%, right? The area where the Fed is happy at is around 4%, 4 point something, but 4%, around that. It could be a little bit higher than 4%, but around 4% is where maximum employment is, right? And that's what we've seen in past history, and that's what Jerome Powell also said in today when he testified, and he was in front of Congress. There was a question about this, and he said that's where we like to see the unemployment rate, but the rate right now is 3.4, which is way better than what they're expecting, which is the lowest since 1969. So what does that tell you? That tells you the labor market is super strong, and he doesn't want it to be super strong because that's going to continue to keep inflation elevated. You need to see some weakness in jobs, which other words means there's got to be more layoffs. Now, whenever we see the unemployment rate reach around 4% or lower, in history we have seen that tends to be a signal that we could see a massive spike in the unemployment rate. That means 3.4% is way better than the 4% expectation that the Fed has, which means that could be the end of the best employment numbers you could see, and we could see a massive spike in it, which means that the Fed may get what they want. We don't know exactly when this is going to happen, but the Fed may get what they want as they continue to tighten and continue to maybe break the economy, because you might see a lot of companies fold, which might cause that big blip in the unemployment rate, which will eventually, hopefully, what he plans to bring inflation down. Obviously, he's not saying it in the way that I'm saying it, but that's what it basically means. Right? So very important there that it's the lowest since 1969. That just gives him more ammunition to continue with the rate hikes, continue to be hawkish, to continue to be higher for longer, and keep fighting back to get inflation lower. So very important line there, very important. So now let's get into the monetary policy. So it titles monetary policy, and then you've got the first paragraph. The first paragraph basically goes over that they want to hit their 2% target of inflation. They're raising rates. They continue to increase interest rates. So here it says, we continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to sustain monetary policy that is sufficiently restrictive to return to the inflation level of 2%. In addition, we are continuing the process of significantly reducing the size of the balance sheet, which has to do with QT. So, okay, we're going to continue raising rates, continue hiking rates, we continue to tighten because we got to get to 2%, as simple as that. We are seeing the effects of our policy actions on demand in most interest rate sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of the interest rate increases over its past two meetings. So they promised that, and they went from 50 basis points, 75 basis point rate hikes, aggressive rate hikes, to now slowing it down to 25 basis points, which they told us last year in December. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. So they're data dependent, like we already know. Although inflation has been moderate in recent months, the process of getting back to 2% has a long way to go and is likely to be bumpy, right? So kind of maybe not going to get that soft landing. As I mentioned, the latest economic data have come in stronger than expected. We suggest that ultimate level of interest rates is likely to be higher than previously anticipated. So this was the key line, along with the next line, which I'm going to read as well, which caused the markets to drop, stocks to drop, bonds to drop, gold to drop, dollar to skyrocket, and cause this panic in the markets, right? So as I mentioned, so blah, 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 blah. Let me just go through it again. As I mentioned, data is stronger. The ultimate level of interest rate is likely to be higher than previously anticipated. Whatever they expected before, they want to push the rate. So whatever they had in their previous projections, they're going to go higher in that interest rate. They didn't tell us what number. We're going to know about that number by, I think it's March 22nd or 23rd, when they're going to have the FOMC meeting. So in about 2 weeks from now, we'll hear what that number is. Is it 5.5 or is it higher, right? So he left that out. We don't know what it is, but most likely it's probably 5.5% is where he wants to push it up. But hey, anything can happen. It could be more. It could be maybe 6% or so on, right? We'll see what happens. Definitely, if it comes in way higher than expected, than what the market expected, you will see definitely panic selling in the stock market, in the bond market, especially on the short end, and definitely gold will be selling off and dollar rallying. Now, he says afterwards, if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. Key point, main point for that sell-off is that this was unexpected, that, hey, we might do faster tightening if the data is not getting better. Which means we might do 50 basis points, a 50 basis point rate hike in the next meeting. So the markets are already pricing in about a 50% probability that the next meeting we're going to see a 50 basis point rate hike rather than 25. So in December last year, he said, hey, we're going to now slow the pace. We're going to do 25. So he did his 25. Now he's coming back and say, hey, we may do 50, right? Because the data is not getting better and it looks hotter. So we may go back to 50 basis point rate hike, but we don't know for how long. But he says, according to the data, if the data continues to be hot, we will be harder and raising rates faster, which might reach to that 5.5 or wherever their target is much sooner, especially before summer, right? So some people may look at this and argue that, okay, that means he's just trying to get to his 5.5% target, his restrictive zone, whatever that restrictive zone is, faster before summer, because most likely when summer comes, he's going to basically kind of pause. And we did hear from one Federal Reserve say that we probably might see interest rates, we might pause interest rates as we approach midsummer or end summer. We might pause then. So if we're going to pause then maybe that's why they're increasing the pace, right? And if that's the case, then that might not cause too much panic in the equity markets. Initially, there might be some selling, but hey, that comes in as expected or as in line because the markets were already pricing in higher restrictive, higher terminal rate, higher level of interest rates to 5.5%. So that's not new news, really, right? What's new news is this faster rate hikes. So, and then he finishes off. So then he says the restoring price stability will likely require that we maintain restrictive stance of monetary policy for some time. And then blah. Then you can read the last two paragraphs, and then not much there, right? So everything's as expected. So let's summarize this. What does this all mean? So definitely, he came in slightly hawkish than expected. Or came in hawkish than expected, especially with the comments of faster rate hikes and more elevated rate hikes. The only thing is, what is that elevated rate hikes? What is that restrictive level? Is it the 5.5? If it is the 5.5, which we will know not now, we will know later, as when that meeting comes. If it's 5.5, then that's old news. That's already priced into the markets. That will not move the markets. So you could argue that the Fed meeting that's coming up, it's not going to shock the market so much because it's already fully priced in. But what is kind of a little bit worrisome that gives the hawkish tone is the fact that he comes out with saying that, hey, we need to do more. Hey, inflation is higher than what we expected. Hey, it might be a little bit difficult to get where we're trying to get to. And again, we're data dependent, which we already know he is, but reiterating we're data dependent, and if data continues to be hot, then we will do what is expected, and on top of that, we may do faster rate hikes, which comes in also hawkish, and then on top of that, which is really, really important as well, the disinflationary process, going back with what, kind of going back in January when he was saying that we are in a disinflationary process and sounding kind of dovish, he's stepping back and saying, hey, we're seeing less signs of disinflationary process. If you look at the super core number, it's not down, it's not where we want it to be, and it's not, not as expected. So the markets are still hot, inflation's still hot, things are not looking good. We're going to raise rates, continue to raise rates higher to restrictive level. We don't know what that restrictive level will know. We'll know when this whole cycle is done with, actually. That could be, 5.5. That could be 6%. I say that there's a good chance that we could see 6% in interest rates. Very much possible. Or at least get close to it. 5.7%. I think is very much possible. And then as we approach and as we continue to do that, and if the Fed does decide to do 50 basis point rate hikes and continues to do that to get to maybe 6% or higher, then sure, something's going to break very, very soon. And it looks like already you're seeing the cracks. And like I said before, when you look at history, at the unemployment rate at 3.4%, the lowest level since 1969, well, that has showed us in history it doesn't end well afterwards. So it is all brewing up. It's coming slowly. The pieces, the puzzles are all coming slowly. This is just another update, another sign to tell you, be careful, watch out for what is to come. The equity markets might be in la land and going up and ignoring the news and what's happening, but definitely the bond market, especially the short end of the bond market, 2-year, is not. You're seeing higher yields in the 2-year, seeing the 2-year sell off, and most importantly, look at the yield curve. The yield curve just hit a new low to minus 1%, negative 1%, way lower than the great financial crisis of 2008, way lower than 2000. So it is looking bad, it is looking rocky, and beware. We'll continue to monitor all this news, all this information, and we'll see what happens during also the data. We have yet to see inflation data to come out. This might be a preview what CPI or jobs data may look like. It may come out hotter than expected, which is why he commented these things. So we'll see. right? And we have CPI also, so we'll see what that happens with, and then we'll see after also the FOMC meeting, and we'll continue to be data dependent. And it looks like if we continue at this pace, we continue to raise rates, and we continue to raise rates at aggressive levels, maybe by summer of this year, we could really see the economy start to deteriorate, and you'll see the numbers look really ugly, and maybe inflation to finally come down. But let's see. Let me know what you guys think. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.